The trust in the fiat currencies has been shaken.
There's no going back.
Silver story has gone from 180 to 320 in roughly 2 months. I am also astonished about the speed. What's the price you are going to put to the last 1 ton remaining silver? Every country is saying, I want to secure my resources.
Ab kya?
This inventory will run for 10-15 days. We are looking at $150, $155. Whenever we gave a 12-month target, it came in 2 months.
What causes the spikes?
The industry is not able to replace the silver. So China has restricted export of silver. Keep buying gold at $5,000 or $10,000, doesn't matter. This buyer is relentless, strong.
Are we just going to be familiar now seeing it at this 90 to the greenback?
I don't see this thing reversing anytime soon. There's a structural problem in the demand cycle. Everybody wants to stock up the metals.
Where are gold prices headed? There's a major risk associated with that. Are there going to be some key events that will be very critical? 2025 was the year when commodities were not just a sideshow, but they became the main event. We saw equities being underperformed by commodities like gold and silver. Silver prices crossed the 3 lakh per kg mark, and the rupee completely lost ground. So in today's conversation, we're going to ask some relevant questions. What is the outlook on gold and silver prices? What should investors truly know before they invest in commodities? And where are the geopolitical headlines actually going to take metal prices? Kishore Narne, who's the Executive Director at Motilal Oswal Financial Services, joins in to decode this and so much more. So thank you so much, Kishore, for joining in. Let's dive straight in, especially with silver prices. I mean, people just cannot get enough of that, and that's where I'm going to start with. From the 3rd of December at 1,80,000 to 2,50,000 at the end of December, we've just about stepped into January and boom, 3 lakhs. Ab kya? I think that is just the main question. I had a very smart question pen, but I think basics. What is going to happen now?
See, in commodities itself is very different asset class actually, because it's a hard asset or a real asset actually, unless the financial assets are very different. So financial assets have a certain amount of your real value, what we call intrinsic value of a share or something, right, or stock or a company. And you have over and above that how much people are willing to pay to acquire that asset. That's how financial assets work. Commodities are real different in a way. For example, I'll just give you a small example. There is abundant water we have, and so water doesn't really have any big value, economic value.
Yeah.
The only thing is, okay, the logistics is something which you have to pay for. So if I tell you that this is the last 100 liters of the water remaining on the earth, how much you want to pay for it, then it's a very different way of looking at it, right? So that's what is the real assets are. So if you can't create that, because in financial assets you can create as many shares as possible, you can expand the company as much as possible, and that expands. Here suddenly if tomorrow somebody asks that I want more silver and there is no more silver available, what's the price you are going to put to the last 1 ton remaining silver, right? So since last 5 years, the silver has been, the total supply of silver has been lower than the total demand. It's structural deficit, what we call it. And 5 years say, and the total cumulative deficit, what we call is the difference between the supply and demand, is roughly 850 million ounces of silver is deficit. It's a 5-year cumulative, right? So, and today the amount of silver which is freely available in the market, there is some silver which is stocked, let's say it's in your home or it's somebody's vault, it's not going to come out, right? This has been locked, or in central bank or government reserves, etc., etc. There's a free float of the market which is there, is roughly around 40,000 tons. And this 40,000 tons, if tomorrow the silver production is completely shut down, let's say due to some reason tomorrow silver production is shut down, this inventory will run for 10-15 days. That's it, hardly. So we have roughly around 10-15 days worth of inventory. And if I have to get this inventory of the bar which is lying in your bank locker, I have to remunerate you to that extent so that you remove that bar and sell it off, right? So the value is dependent on how much a buyer is willing to pay and
Yeah.
what is the availability. So silver story has gone from as you rightly said, 180 to 320 in roughly 2 months, right, around 30 trading days, let's say 30, 40 trading days, is just because as we get towards the fag end of that, the remaining silver available in the market is getting shrunk.
Yeah.
The speed and acceleration of price hike per every ton increases significantly.
Okay. So what's this year going to look like for silver?
Right now at 320, 325, I am also astonished about the speed which it went up. So, if we see that around 2 months, it's almost close to around 100%.
Yeah.
An asset really cannot move that fast.
Okay.
So, there's a lot of speculative froth which has been built also.
So
So, my
consolidating.
idea is it should correct by around 10, 15, 20%.
Okay.
So, after 170, 180% move, 10, 15, 20% is just a bull market correction.
Okay.
So, structural trend will still remain. Short term, it should come down a little bit to cool off and shake out some of the weak participants in the market. But eventually, we are looking at 150, $155, which is roughly translates in India to around 5 lakh, 5.5 lakh rupees. But again, when I say this, we generally look at a perspective of 12 months to 18 months.
Right.
Whenever in the last 2 years, whenever we gave a 12-month target, it came in 2 months. I don't know whether this time also it will be repeated, but if I am looking at a fundamental view, I generally look at a 12-month target. So 12-month, I will not be surprised at 5.5 lakh.
Okay, so let's see where it's headed. But you're saying that structurally it will remain strong, but this short-term correction is inevitable. Now let's get to the big picture of commodities, because 2025 was a year when commodities was not the sideshow. It was pretty much the main show. You had the tariff shocks that took place, lots of moving parts, geopolitical stories, and that really influenced the prices of precious metals. What does 2026 hold in store, and how would you characterize 2025?
The basic thing one should understand, what triggered this rally in commodities is, again, it comes back to the shift in global policy. Right. So, the entire globalization post Second World War, the entire world which is built on globalized world, where there is fundamentals of free trade has been established. The WTO actually ruled the world, and the FTAs across the countries, and there is a lot of free movement of goods and services across the world. It it brings a lot of efficiency, right? So then most of the companies or the corporations will build what you call just in time inventory, right? So I don't need to really stock my raw materials, because I can source the material any point of time. It will hardly take 10, 15 days for the material to come from China or from Brazil or from South America. So I don't need to really stock for a 6 months inventory. So I just need to stock a 1 month inventory, so that I can. So when the trade is free flowing, you actually don't hold too much of commodities. Commodities is nothing but the raw materials of the industrial world, right? As the policy shifts to protectionism from globalization, now every country is saying, I want to secure my resources. I don't want to have a free trade. I will put tariffs, barriers, etc., etc. Everybody looks at me first, and then I will look at the external world. Then what happens is you disrupted the entire free flow of the commodities. Then as a corporation, now I am not sure I will be getting the inventory just in time. Then I need to stock at least 4, 5, 6 months of inventory, so that I can keep my operations not disturbed. So suddenly entire world is storing, rather than a half a month inventory or a 1 month inventory, to a 6 months inventory. So you created a huge amount of demand for commodities, and a lot of money went into this. Somebody has to finance this trade.
Right.
So a lot of finances has built into these exchanges and all those things, and it became productized, ETFs, etc. All this money came, which actually pushed the entire commodity rally.
Right.
Right. This is a structural shift.
Absolutely.
So I don't see this thing reversing anytime soon. We are not going to go back to the globalization anytime soon, right? So it will take a year or two for the new normal to be adjusted.
Okay.
Yeah.
There's this growing narrative that silver is the new gold, and not just because of the price, but because I believe that there are consumers who are increasingly even treating gold as an investment. They're buying bars, they're buying coins at jewelry stores. But you said that there's a major risk associated with that.
Yeah.
What is the risk?
I don't really agree with that statement that silver is new gold. So, because they're completely different characteristics. 59% of silver is consumed by industry. It's an industrial demand. It's an industrial metal.
Yeah.
Right. Roughly around 10% is financial asset. Right. The ETFs and the exchange traded commodities, etc., etc. Around 20-30% comes from non-traditional sources like bars and coins and these kind of physical inventories which have been built. This is a investors are very temporary phenomenon. The moment if the price becomes shaky, they run away. It's they are very fickle.
Yeah.
Right. The problem in silver is the industry is not able to replace the silver with any other metal despite the price rise. What we call it is thrifting of demand. So, if I use X amount of silver in a particular, let's say in a solar panel or in a EV or something, because the price of silver has went up, I should be able to replace it with something else.
Yeah.
With the same amount of functionality, right?
Right.
That is not happening, right? And one more large consumer which suddenly cropped up is the warheads. The missiles, let's say the US Tomahawk missile, it's one of the big arsenal of US. Each Tomahawk missile has 15 kilograms of silver.
Okay.
Each. So, they have around 350 missiles orders placed. So, similarly with China. So, China has restricted export of silver now, right? So, suddenly everybody wants to hold their silver back, right? So, that's different. But gold is fundamentally a financial asset. This is not an industrial commodity, right? So, central banks or the large fund houses, family offices, banks, everything, if they have to hold a safe haven asset, that's gold.
Okay.
Right. So, right now because the momentum is playing, a lot of investors are coming to silver, but I don't think they are going to sustain for a very long term.
Okay.
Yeah.
So you said gold is a safe haven, gold is a financial asset, and gold should be seen as a currency, as store of value, and not as an income producing asset.
Yeah.
Elaborate on that.
First thing is, it's not an income producing asset because it doesn't pay you any dividend or it doesn't pay you any interest. So, definitely it's not an income generating asset. Second is store of value. It's been since centuries. Gold has been store of value. That's the first store of value mankind has discovered, and since then it's been in that realm, right? There is nothing which has replaced or centuries in that. Gold is turning into currency because gold started as currency, and then the fiat currencies replaced gold. As the we came with dollar and post Second World War, post globalized world, the fiat currencies replaced gold. We have removed the gold standard, and it actually helped us to expand global economy because gold on its own has a limited supply. If the money supply cannot be expanded, it's a big problem for money. You should be able to expand money when it is needed, and you should be able to shrink money when it is not needed. That's how the central banks control inflation and growth, the cycles of economy. So, but now the trust in the fiat currencies has been shaken. Trust is very difficult to build, very easy to break, right? So, the approach, unfortunately, US has chosen to break the global trust and to break the global institutions, actually forced everyone to look back, what is my alternate?
Yeah.
Right? So, there is no other alternate. Till the alternate is found, gold is the only alternate. Gold really cannot replace money. I don't really believe that. But there will be a system which will be gold based. And for example, our BRICS nations, which have been now roughly around 45 countries, which is now associated in BRICS, are trying to settle their trade within their own currencies, right? At some point of time, they will migrate to a system which could be a blockchain based, which is backed by gold, and some kind of a system which will replace SWIFT. So, gold as a money will stay, but it's the problem is the logistics. It's not easy to transact in gold and transmit gold. So some system will evolve, but it will be based on gold. So that's going to be the new reality.
You also debunked a huge belief that India's festival season does not directly cause price spikes. What causes the spikes?
See, India consumes roughly around 850 tons of gold. Out of the total around 4,800 tons of supply in the world, right? And we have been consistent on that. So on a bad years around 600, 650 tons we consume. On a good year we consume around 800 tons. So if there is a consistent demand, price doesn't really get impacted by that.
Okay.
You need spikes in that,
Hmm.
right? The spike comes from investors,
Okay.
right? So when the prices move up, suddenly a lot of investors rush into this asset, creating that spike in the demand. When the things are shaky, they run away from the market, they sell whatever it is there, they actually create artificial supply,
Yeah.
right? So that additional new buying is what creates the spikes. So the buyer who came into this market since last 3 years or 4 years has been the central banks, global central banks. It's not the retail. The retail has been a late entry. The global central banks started accumulating gold since post COVID and all, and they have accelerated. Now roughly around 1,000 tons is bought by central banks itself every year, which is roughly around 24-25% of global supply, right? That's a buyer who doesn't see the price, who doesn't look to sell instantly. If tomorrow if the price falls by 10%, these people are not going to sell. These are going to store this forever. And these people have nothing to do. They will keep buying gold at $5,000 or $10,000, doesn't matter.
Yeah.
So this buyer is relentless, strong, and very long term. So that actually created the solid foundation for gold prices.
Okay. So that's some of those commodities. If we were to touch upon away from precious metals and were to talk about rupee, because in 2025 it's certainly lost ground. Lots of factors, of course, attributed to that, geopolitical factors, and then there was that FBI exodus that we saw.
Yeah.
What is the future for the rupee dollar equation? Are we just going to be familiar now, seeing it at this 90 to the greenback?
Probably yes. I think
There's no going back.
Going back is like, see, if you have a huge turnaround in Indian growth, so if you are going back to around 8.5% nominal growth, and then we'll have suddenly reversal of capital flows and all those things, probably you'll be appreciating to around 87, 88, not beyond that. But before that, can we depreciate to 92, 93? Yes, possible, right? So not surprising thing is government and the central bank are comfortable at these levels.
Okay.
They're not panicking, right? And to some extent, we have absorbed the tariff hit by depreciating currency,
Right.
right? Because for Indians, exporters, the amount of rupees they are getting for the same amount of dollars is higher because we are producing in rupees. For American buyers, because the dollar has appreciated, some of the tariff impact has been absorbed in the currency depreciation. So that's good for us in a way, but capital flows are very different. So capital flows have because FPIs have been selling, and capital flow some of the investors see India as a non-stable currency. So the flows are not confident enough. But if our growth returns, earnings growth and the overall economic growth,
Yeah.
I think the capital will turn around.
Okay, that's the outlook on gold. We're going to be accustomed to, rather, that's the outlook on the rupee. We're going to be accustomed to 90 to the greenback. Now, crude as well, it's been quite the year. The geopolitical factors, the sanctions, China demand that we've seen, OPEC supply concerns. What's your base case for crude, and what would surprise you?
See, for the last 2 years, crude is struggling with a lack of demand. Actually, crude demand is very poor, right? There is abundant supply. Actually, even to stay at these current levels of $55, $60, there's a lot of push from OPEC, right? Despite Russian oil, there are sanctions on Russian oil, despite sanctions on Iran, despite Venezuelan oil is not available in the market, despite all these things, prices have not moved up. Actually, in fact, they have moved down. Actually, from 68, they come down to 55 or $50. There's a structural problem in the demand cycle. and there is enough supply which can be tapped into. Yes, it's not available currently, but if the prices goes up, because even today shale is not very profitable for US suppliers, but at 60-65 shale becomes very profitable.
Yeah.
So there is a lot of supply which can be really tapped into. That actually keeps the crude prices lower. So my base case scenario is around 55 as an average price for 26. Best case is around 64-65 and the worst case is 50.
Okay. Now, 2026 stacked with lots of macro events. You've got the new Fed governor, Davos, which is underway. We will see, of course, movement by the Fed, ECB, BOJ. In light of all of this, how is this going to impact commodities? Are there going to be some key events that will be very critical?
See, despite Fed not cutting interest rates as expected, globally the markets, financial markets have been trading very close to their all-time highs. There's not much of, despite a massive amount of negative news, negative geopolitics, every risk factor has been highlighted so much, but despite that markets are not coming down because non-US liquidity has been really flooding the market. Japan has been flooding the market with liquidity. India itself has been doing a lot of OMOs and our liquidity has been much far higher than what it's been. So, Europe has been pushing liquidity, UK has been pushing liquidity. So, there is a lot of liquidity. Traditionally, we are used to the US liquidity, but now it's a non-US liquidity which has kept the markets higher.
Okay.
Even the China stimulus. So, I don't see any turnaround in that story. The China has to continue because even the last housing numbers in China has been pretty bad. The housing sector still needs a lot of support. So, Chinese stimulus is going to continue.
Okay.
Japanese stimulus is going to continue. India will continue to boost its liquidity. So, that liquidity is going to hang on and hang over around the markets. So, the only thing which can disrupt this is any major geopolitical event.
Okay.
So, whatever happens to Greenland or whatever happens in South America or whatever happens in Iran is going to shake up the markets for a short term.
Okay.
But I think a sustained downtrend in financial markets can only be led by shrinking of liquidity in Asia.
Okay, fair enough. So it's going to be a big political event, perhaps, that will shake the ground for
Yeah.
commodities. Now, copper as well surged hard in the year gone by, nearly $13,000 per ton. And then, of course, you've spoken about this increased EV adoption, the fact that China as well is expected to cut production in some of their leading smelters. Where does this take copper prices?
See, absolute short term, most of the industrial metals are slightly tired of the rally. They have now lost the steam. There is a little bit of clampdown from the Chinese regulators of late, especially last week. They have actually cut down the amount of positions we can hold on the exchange. They have cut down the limits of the trading limits. They have cut down the high frequency algorithmic trading positions. They have actually asked the people to remove the servers from the colo facilities there. So, that's going to impact short term. But medium term to long term, that's around 6 months to 18 months. What we're looking at is structural trend is still positive. These metals are helpful in two sectors. One is the housing and infrastructure. Second is the global geopolitics, because when you are actually preparing for a kind of a geopolitical environment which you are there, it could be a possibility of a war breaking out, something. Everybody wants to stock up the metals because that's for the war premium is getting built. Second, everybody wants to hold on to their minerals, right? The ore which has been freely circulated is not. Third is, as you said, China has cut down on smelting facilities. A lot of smelting capacity has come down. So, that's actually another factor which will. So, if you are looking at 18 months, the $13,000 copper could become around $17,000, $17,000. But short term, I think in the next a month or two, there will be a lot of cooling off in these metals.
Okay, and finally, if I may, can you tell us which commodities you're invested in and what should an investor's ideal allocation be to which commodities percentage-wise? Just roughly, just a quick answer.
Yeah. So, I think if you are a pure financial investor, you can just stick to gold and silver,
Okay.
right?
How
So,
much percent of the total?
yeah. See, generally we look at anywhere between 5 to 15% as a portfolio allocation to gold and silver or precious
Combined.
metals. 5 to 15%.
Combined gold, silver, yes.
Combined, yeah, so for precious metals. But that's a general rule of thumb.
Okay.
So, but tactical allocations are different. So, what happens is, if I'm generally investing 15% in precious metals, in a normal scenario, when risk is elevated, right, when there is a significant risk in financial markets, I reassess this balance and go to 25% gold and silver, which is my safety bucket, and reduce my general allocation to financial markets.
Okay.
So, if I am having 25%, whatever the allocation to precious metals, keep 70% in gold and 30% in silver. That's the ratio which is a very, very what you call safe, which will give you the essence of silver, but also gives you the protection from gold.
Okay. Now let's get to a rapid fire, Kishore. This is going to be quick, snappy, rapid answers. Gold in 2026, higher, lower, or range bound?
Higher.
Okay. Silver, will it outperform gold in 2026? Yes or no?
Maybe, but towards the end of the year.
Okay. What's going to be the biggest driver for crude prices? Geopolitics, demand destruction, or OPEC?
Demand destruction.
Okay. The most misunderstood commodity indicator that retail investors just have to stop using?
I think dollar index.
Oh, okay. And your top commodity for the year 2026, what's it going to be?
Gold.
Okay. Been very interesting talking to you. Thank you so much for opening our eyes to all that's happening in the world of commodities, because it's certainly taken center stage.
It's my pleasure.
All right, that was certainly an interesting conversation. 2025 made one thing clear, that commodities are not just in hedge, they are becoming core strategic assets. And we have seen a lot of movement, and 2026 is going to be a very interesting year. So we've been given a framework of not just what the outlook is, but how one should react to this. Thank you so much for watching. We do hope you like, share and comment on this video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.